All right, well, we'll go ahead and get started. Thanks everyone for joining. In case you don't know me, my name is Nathan Davis, and I am the CIO here at Aspen Wealth Management, as well as being a senior wealth advisor and partner. We started doing these quarterly market updates about 3 years ago, and we've been trying to stick to them ever since. I will say that I feel like I never appreciate the stock market media as much as I do when I'm trying to come up with one of these presentations. And maybe it's a good thing, maybe it's a bad thing, but I have no idea how they find so much to talk about on an everyday basis, because when you look at it and you take out some of the daily volatility from a quarter to quarter perspective, it is not uncommon that not much changes at all. So the fact that they fill every minute of every business day with some kind of market talk is almost impressive. It gets a little bit hard sometimes. Jim, if you first time I advance my slide, just so that I know it's working, go ahead and give me a go ahead. For today's topics, what we're going to talk about, we will do an equity and fixed income market update. As I kind of alluded to in my introduction, many of the trends from 2023 have really continued into the first quarter of 2024 and today. Specifically for both equities and fixed income, we will talk about a few different relative valuation measures when we're saying, hey, when something a good investment, where's it trading at today? Is it normal? Is it a good opportunity? A lot of that comes down to relative valuation, and we'll spend some time on. We'll go through a general economic update. The spoiler alert on that is that inflation remains sticky. And even just in the last really week or two, we've had some surprises as it pertains to inflation. But all that said, the concept of a soft landing is still possible. A soft landing just being, us keeping inflation lower than it was previously by raising interest rates and still avoiding a recession overall. Very much still possible. Lastly, after we review the equity and fixed income markets economic update, we try to tie that all back to implications for investors. When it comes to asset allocation, what are the considerations with all the data that we talk through? When it comes to portfolio management considerations, how should we look at things with all the data that we talked through? Asset allocation being, choosing what you should invest in and what amounts, and portfolio management being, well, once you've got that target mix, what do you do with it from there? How do you manage it from an ongoing basis? We'll close it all out with implications for investors, tying all this data together. Always like to start with our investment philosophy. We look at a lot of data. We talk about a lot of data. We look at, hey, what might this mean for the future, or what can we try and predict given this data? But when all is said and done, our investment philosophy is still very straightforward. We like a disciplined approach, regardless of market conditions. All that to say is that we're not market timers. We're mindful of all this information, but it's a lot more long-term trends that drive our investment management decisions, not anything that happens in just one quarter, 1 month, 1 day. It's a research-driven philosophy. It's grounded in academia. We like globally diversified. We like cost-conscious. Our philosophy is goals-based to help engineer a portfolio's long-term success, again, with the focus on the long term. And then we have a dual risk mandate, meaning that for all of our clients, we look at both the willingness to take risk, or sometimes called the risk tolerance, as well as the ability to take risk, all determined as part of their financial plan. Looking to actual market returns for the quarter, great start for the U.S. stock market. It was the 14th best start to the year on record for U.S. stocks, up just over 10% for the quarter. Included in that performance was reaching a new all-time high for the S&P 500. International developed stocks also had a better year, while still falling short of U.S. stock market overall. Really surprisingly, international developed over the last year has compared pretty favorably to the U.S. Relative to the last 10-year performance. I mean, the last 10 years, U.S. has outperformed internationally so substantially. International is really trying to catch up over the last year. They contributed that a little bit in Q1 as well. Overall, real estate down a little bit, U.S. bond market down a little bit. Both of those are pretty tied to interest rates, market expectations. We'll talk about that a little bit more later. But for the most part, the drawdowns there were pretty insubstantial. Looking back a little bit further, so more than just the past quarter, the past 1 year, 5 year, 10 year for all of these same asset classes, U.S. stocks have really been on a tear over the last year, up just over 29%. International stocks up over 15, well ahead of their long-term average. Even our emerging markets, our real estate, everything is looking good for the last year, a lot of which has to do with the fact that 2022 was such a bad year. All of those rate increases we saw from the Fed, all of that high inflation. We did finally start to see recovery in 2023 for a pretty quiet but pretty great year in 2023. And a lot of that is just built into this last 1 year return. It still very much surprises and impresses me when we look at the 5 year, the 10-year performance. All of the volatility that we've had, particularly in the last 10 years, we've pretty much had 2.9 bear markets in the last 10 years. We were just shy of one at the end of 2018. But the long-term average for U.S. stocks is just about 10% if you look back far enough. But over the last 10 years, U.S. stocks have averaged over 12% a year. So well above average in not a short amount of time. Really, the shorter we get on a 5 year average, which would include the pandemic, include the down year in 2022, for U.S. stocks to be returning 14%, over 14% a year for those 5 years is really impressive considering some of the volatility that we've had. Equity market themes overall, as I mentioned, we did hit a new all-time high in U.S. equities. A lot of the market segmentation that we've talked about in the past has very much persisted. There are the Magnificent Seven, as they call them now, 7 largest companies in the United States that have provided a lot of the return. Some of the characteristics of those companies relative to others has been pretty different. We'll dive into that a little bit. And then overall, with the exception of the last week or so, low volatility trend has continued. It hasn't been a whipsaw every day of these like plus or minus 2% trading days. For the most part, for the last 15 months now, it's been upward trending markets with very low intraday volatility. That has reversed again kind of in the last week or so, which shouldn't really count in a Q1 market review, but it did happen until like the last week. But for the most part, we've kept with a pretty low volatility trend in U.S. equity markets. I always like to every now and then throw this in as our starting slide. Really, all that I like this slide for is that it's just our visual representation of why we want to stay invested. It's our visual representation that if given enough time, regardless of the volatility that can occur in any one given year, one given quarter, 2-year stretches, whatever it may be, that if you stay invested, the S&P 500 and U.S. stocks overall will provide returns over time. You have to be patient. You have to wait it out. You absolutely have to ride out some down years. But this shows us that, if you're investing in stocks, you're rewarded by being a long-term investor. You're rewarded by being patient. Just seeing how substantially markets have grown over the last almost 30 years. More recently than that, we are still above and beyond the previous market peak, which was the very first trading day of the year in 2022 when things started selling off. We're 40% above the relative low that we saw at the end of 2022 after the correction started on that bear market. And then one notable data point here is just our valuation measures. So markets are at a higher level than they were at our previous peak. But thanks to earnings growth in 22 and some of the earnings growth in 23, even though it's been a little bit flat so far this year, earnings have grown as well along with those prices. And so from a relative valuation standpoint of looking at the price as a multiple of the earnings that these companies have on aggregate, our valuations are actually a little bit lower relative to earnings than they were at the previous market high. And so going back to some of the sources of earnings growth, with now that the fourth quarter earnings season is in the books, where fourth quarter earnings are announced all through the first quarter, earnings growth finished 2023 flat despite a year of above average economic activity. So while results are seemingly lackluster and they seem to fall short, initial expectations for earnings were actually a contraction to see earnings take a few steps back. So we have surpassed initial expectations, or we did surpass initial expectations for earnings. Now that we can kind of close the books on 2023, overall robust economic activity supported revenues, was the largest contributor to earnings growth overall. We did see an increase in revenue, but what has led to our flat earnings growth is that while companies were able to increase their revenue, they did see a decline in margins, which was likely due to just some higher wages, some of their input costs still being sticky with inflation. You could always point the finger at geopolitical turmoil that has started to pick up in more ways than one across the world, all of which were contributions to, yes, companies were able to make more money from their top line. They were able to bring in more revenue, but for the most part, their costs increased by an equal amount, decreasing their margins and leading to pretty flat earnings growth. One thing that we do have hope for earnings estimates going forward is, the adoption of AI, more efficient technological processes. What are these companies going to be able to do with all of those advancements in technology to lower costs, make the people that they have on their payroll more productive, and hopefully lead to more earnings growth in the future. While profits could experience healthy growth in 2024, you'll see on the right-hand side of our slide here what the consensus estimates are for earnings growth. To think that we're going to have double-digit earnings growth is pretty lofty expectations. One of the downside risks that we have in markets and prices today is that really high expectation for earnings growth. A lot of times when we see volatility in our markets, it's just because reality and expectations have some sort of deviation. So when analysts, when companies themselves are forecasting earnings growth to be that substantial, it does kind of set the scene for a little bit more a little bit more market volatility through the end of the year if reality on earnings deviates from what is a pretty strong expectation. We also need to be mindful of looking at the Magnificent Seven, those large seven companies that drove the lion's share of earnings growth in 2023. Are we going to be able to see some of that earnings growth spread throughout the rest of the market instead of being dominated by those notable large seven companies? Another thing that we've been monitoring, this isn't really that much different from last quarter, is index concentration, how those positions, those Magnificent Seven, or just the top 10 publicly traded companies in the United States, how they relate to the rest of the market. So after an impressive 2023, U.S. equities have continued their upward momentum in the early months of 2024, with the exception of a little bit of some volatility in the last 2 weeks or so. But in fact, those resilient corporate profits in hopes for just general economic policy easing have produced multiple all-time market highs this year. So as we said, that March 28th, most recently, was a new all-time high for closing prices for the S&P 500. However, while it's good that our S&P 500 is hitting all-time highs, that market performance remains concentrated as the largest stocks in the index continue to have their dominance. Valuations might look stretched when we look at that overall multiple of price relative to earnings and future earnings estimates, but there are still plenty of attractive opportunities that exist outside of just this group of the 10 largest stocks in the United States, those mega cap stocks. On the left side of our slide here, we compare the price to earnings ratio. So again, what price are we paying today per dollar of future earnings? It's our best metric for the value of these companies that we are investing in. The chart on the left hand side shows the price to earnings ratio of the top 10 stocks in the S&P to that of the other 490. Historically narrow nature of the recent rally, meaning that just those 10 stocks driving those returns, that is abnormal compared to history, but it has left those top 10 stocks significantly more expensive than the rest of the index, meaning if you look at all of our estimates for their future earnings, you have to pay more today in order to keep those same future earnings. So it's left those stocks significantly more expensive than the rest of the index, while all of the other stocks that are indexed look relatively cheap. If we're talking about a 27 times earnings multiple for the price that we pay for $1 of earnings, the rest of the S&P 500 is just over 17 times. You pay 17 times $1 of earning for the average price of all of those companies. That is a substantial deviation. It's notable. It's not by any means, just like with anything investments, it's not a perfect predictor of what's going to happen in the future, because it is also always possible for any of those companies to outperform earnings estimates. And yeah, it seems like we're paying a high multiple of earnings today, but if their earnings end up being beyond and above what anyone thought that they could have been in the future, it still kind of works out from an investment perspective. It's why we still want to own them. We just want to moderate our allocation to them. But it really is an interesting visual representation that the U.S. market is a lot more than just 10 stocks. But when you tune into the news, you see what the S&P 500 is doing. It's largely being driven by those 10 stocks over the last year or so. It just paints an interesting picture of what the near future could look like as we get a more return to normal across the broader index of the S&P 500. And while that concentration is not a new phenomenon, it's very much been an issue, and it has been rising since 2016. The domination of earnings that we saw, the earnings growth we saw last year from the top 10 stocks, it just really can't keep pace over the long run. There's only so much of a contribution to earnings growth that those companies can provide, and it does have to slow at some point in time. Important to note on the right hand side. So while those top 10 stocks represent almost exactly a third of the index, 33.7% of the S&P 500, they're only contributing 25% of the earnings. So it goes to show that the other 490 companies that are made up of the S&P 500, from an earnings perspective, they're very much providing earnings. It's just the prices that they are trading at relative to those earnings has remained depressed. A lot of that has to do with just the investor sentiment towards those really large names and continuing to pay higher and higher prices. So it's something that has really started as a trend all the way back in 2016. The last 15 months has been a very noticeable trend, and it's something that we're going to continue to keep an eye on. Expanding that out a little further, we do spend a lot of time talking about the S&P 500. There are a whole lot of publicly traded companies that are not in the S&P 500. Not to mention, U.S. companies that aren't. There's about 2,500 other U.S. publicly traded companies that are not represented in the S&P 500. But to take that further, there are plenty of very good companies that are represented overseas on overseas indices with those, international companies, whether it be developed markets, whether it be developing, emerging type markets. And so while many U.S. investors, we do tend to feel inclined to focus on U.S. markets, there are attractive tailwinds for, that are starting to develop now outside the U.S. that we really do want to pay attention to. The slides that we're looking at here just aim to highlight some of the opportunities that we want to, that, do exist outside the United States in terms of some of those country specific allocations. In terms of earnings growth, as we see on the left-hand side here, the United States very much has been the standout over the last 18 years. But we are starting to see more promising trends in countries like Japan and areas or regions like Europe that have allowed companies to raise their prices, expand their margins, and not to mention the negative interest rates in both of those countries, or a country in a region, should help boost profits for financials for key sectors of both markets. There's a lot of opportunity in terms of the value, going back to that price you're willing to pay per dollar of earnings. Internationally, there is a lot of value to be seen. With highlighting China here, the China markets have struggled recently. We've had strong equity returns everywhere other than China. And overall for China, we still don't think that there have been enough developments there to make their markets trustworthy. And so it's included here just to highlight that, what would theoretically be the considerable earnings growth that China has participated in over the last 18 years. There has very much been a pause and reversal of that trend. But the big reason that China is excluded from a lot of emerging market indices is that investing in China is still very difficult. What we'd like to see here more is the positive trends that seem to exist for, Europe outside of just the UK. For Japan, with the changing demographics that we have in Japan, they're always so ahead on technology. With the emergence of AI, it seems like that would be a really good opportunity for finally seeing a turnaround on the Japanese economy. All things that we want to be mindful of overall. Looking at our fixed income markets, so interest rates have continued to increase across all maturities. The yield curve inversion steepens, just our front end rates continue to be higher than the mid and the long term on our yield curve. Overall, the market dynamics remain attractive. There is still a lot of opportunity to invest, but still a few unknowns, particularly going into the end of this year, what 2025 might look like for interest rate expectations, stuff like that. And then from all that we've been told and for all the data that exists today, the Fed is at the end and has ended their hiking cycle. The conversations have very much turned to when they will start to cut rates. And then more so recently, I say a lot, it seemed like on the way up, people were saying, how much are we hiking? How much longer are we going to hike for? How substantial are those hikes going to be? And then the moment that people expected that our last hike had been made, it completely flipped to, well, when are we cutting? How substantially are they going to cut? How long are they going to cut for? With no discussion on the fact that rates can do three things. Yes, they can rise. Yes, they can fall and be cut. They can also just hold. And it's very possible that rates just hold where they are at a time, especially depending on what inflation chooses to do here soon. But from everything that we've been told with the data that exists today, the Fed is not looking to hike interest rates any further. It's just becoming, are they going to keep rates where they are, or are they going to cut them type conversation, which does have quite a few implications for fixed income markets overall. Late last year, getting into it with Fed funds rates expectations, late last year, Federal Reserve sparked investor enthusiasm when they said that, hey, they were done raising rates. There was going to be a short period of holding, but then that they were, targeting rate cuts, and they were signaling themselves, 3 rate cuts at the end of 2024. At the March meeting, the Fed Reserve left their rates unchanged at a rate of 5.25% to 5.5%. And they did continue to signal 3 rate cuts, without necessarily the amount, likely small rate cuts by the end of 2024. But they've started to adjust their forecasts for rate cuts in 2025. They were previously forecasting 4. They've now cut that to 3. They've also boosted their projection of what the long run federal funds rate will be from 2.5% to 2.6%. In Fed world, that is a huge adjustment. 10 basis points to me is not the end of the world, but at least they're signaling that they're open to change, and whatever their initial expectations are may not play out to be the case. They're willing to adjust. But, in addition to the rate cuts, the Fed signaled that they plan to slow the pace of quantitative tightening fairly soon. A big reason that markets, that debt got so cheap and equity markets were able to run and money felt so free with those low rates was when the Federal Reserve embarked in quantitative easing post-Great Financial Crisis. They were buying up bonds, they were putting cash into the system, they were flooding the system with liquidity. In addition to increasing their target rates, they started doing the reverse of their quantitative easing, their quantitative tightening, which was they were selling some of the bonds that were on their balance sheet. They were introducing bonds back into the system. They were sucking out some of the cash. Also has an impact on rates overall when you look at the supply and demand of the treasury market. And so, the twofold measures that the Fed has been pulling for keeping inflation low has been raising their rates, which hopefully they've now paused, as well as selling some of the bonds that are on their balance sheet, taking cash out of the system. And so when all is said and done, it's going to leave the Fed with a much larger treasury holdings than it had before the pandemic for an extended period of time. But it has still been a considerable difference compared to where they were at the tail end of the pandemic. They've adjusted their balance sheet. Overall, that should help long-term rates hold as downward a little bit longer. We're expecting most of the moves in the interest rate market to still be in the 3 to 5 year at most and below. Just looking at the supply of bonds in the market, largely to do with quantitative tightening by the Federal Reserve. Market expectations for the Fed, their messaging has very much been in sync. They've made tiny changes to those expectations over time. They've continued to say that it would take a meaningful change in economic outlook to trigger any sharp movements and long-term interest rates and changes to their strategy going forward. And so it seems like, while inflation can surprise us, and we'll talk about that a little bit in a minute, for the most part, the Federal Reserve has indicated that they're done raising rates. They've laid out their expectations for what those rates will look like in the future. Really, and has only changed in the last 2 weeks. If we look at the tail end of this chart, going back to the comment I made earlier on when there are expectations for what markets are going to do in the future, and reality ends up being different. With the fixed income markets, there's kind of two level of expectations and forecasts that can disagree with each other and also be different from reality. And that is that the Federal Open Market Committee, so the Federal Reserve, they estimate what they think they're going to set their rate at in the future. In addition to that, market participants, anyone who's buying and selling bonds, they get to have their assumptions based off of what they're willing to trade those bonds at today, of where they think rates will be in the future. And then there's always the spread of, well, what are rates actually going to do as all of this new data comes to light? This end of the chart here, when we look at the deviation between market participant expectations and what the Federal Reserve themselves say they are going to do with rates, if we had this presentation 2 weeks ago, it would have been no different than when I gave it last quarter. But with our most recent sticky inflation print, it flipped. Prior to that, all of our market expectations were below the FOMC year-end estimates, and that market participants thought that the Fed was going to lower rates more than the Fed themselves said that they were going to lower rates. As soon as we saw higher inflation, the whole reason that the Fed raised rates to begin with was to get inflation under control, get it closer to that 2% target. Once we saw a reversal in our downward trend, we saw a sticky inflation print come out in the last week. There was some quick turmoil in the bond market where things flipped. The market expectations for rates are now higher than the Fed estimates, indicating that market participants think that the Fed will have less rate cuts or less substantial rate cuts through the end of the year, through the end of next year, than the Fed themselves are signaling. Something that we like to be mindful of. We'll talk about it a little bit more here in the fixed income market dynamics. of why that matters, 1% either way, why does it matter? When we look at the impact of the entire, bond landscape, there's a little bit of a skew right now, which is a good kind of skew. It's better than the skew that we had at the end of 2022 when rates were, at the end of 2021 when rates were very low, in that if there's a 1% rise or a 1% fall in interest rates, as we've talked about, considerably since the beginning of 2022, as rates rise, bond prices fall. The reverse is also true. As rates fall, bond prices rise. If we look at the market as it exists today with our new higher yields that we didn't have previously, you can see that there's whether rates move up, whether rates move down, there's a lot of segments of the market, like the 2-year or the 5-year, our 2-year U.S. Treasuries. If rates were to fall by 1%, you could expect to receive your coupon of about 5%, and you could expect to see some price improvement on your bonds. Yeah, you go into 5% bond, and now rates are falling, and you're only paying 4%. Which could translate to a total 6.8% return, just mathematically, for bond pricing overall. And on the flip side, where we've spent a lot of time talking about how rates rising are bad for bonds, caused a lot of turmoil in 2022. But on the short end of the curve, even if rates were to rise another 1%, you're still earning 3.2% on your 2-year bonds. And looking down the stack of various asset classes and fixed income, we see a lot of markets where if there is a trade-off between, yes, if rates rise, you're going to lose some money. When we look at it relative to what you would earn on those same bonds if rates were to fall, it's not symmetrical. On the 10-year U.S. Treasury market, you can have the potential of earning 12.5%, while running the risk of a 3.3% net loss after you collect your income, after prices fall, if rates were to continue to rise, where as an investor, that starts to look like a pretty attractive trade-off. With higher yields offering attractive yield cushion, the impact of a 1% rise in rates today, not that we think that it's incredibly likely that rates will rise by 1%, but the impact of rates rising by 1% is completely different than it was at the end of 2021, because we're at a higher base. We have a really good cushion in markets, where on the flip side, if we do see the Fed start to reduce rates, we do see those reduction in rates start to flow across the markets to different terms, to different asset classes. There's very much potential for asymmetric returns, or at least asymmetric expected returns, if we are diversified in our bond portfolios, if we're diligent and purposeful in our asset allocations of when we're investing in bonds, what kind of bonds are we investing in. There's very much a lot of opportunity. You're going to hear a lot in the news about this high inflation print and what it means for rates, and are they holding, are they falling, are they maybe going to have to rise again? And I follow that news very closely, and I let it bother me very little, because no matter what rates do, and we can't control it, and we really can't predict it because it's based off of data that's not even available yet, like inflation. When we know that we're investing in this asset class for a reason, we know that the fundamentals in there look really good. And there's no sense trying to perfectly time things or think that your track for interest rates is the right one. Invest with purpose in your fixed income. Be mindful of a 1% rise or a 1% fall, how that could translate and flow through to your investment portfolio. But for the most part, don't let it keep you up at night. The market itself looks really good, whether rates go up, down, or, as I said, they started all, unless they're just sideways, they stay where they are for a while. The fixed income market looks way better than it did today. It looks way better today than it did at the end of 2021. General economic update. I think it's kind of hard to go back and forth between fixed income and the economy, just because they're so intertwined anyways. It's hard to segment, one versus the other. But general themes for our economic update is the economy is holding up. We're still seeing growth. Of course, there are recession risks that remain. Whenever we see inflation that's not doing exactly what the Fed wants it to do, like the recent uptick we've seen in it always has a ripple effect of, well, what could be the, next thing to fall? And is there data that we're just not aware of? There are still recession risks that remain, but overall the economy is looking really good. Unemployment, it's possible, if anytime we talk about recession risks, it's possible that unemployment may rise. We really feel like even if unemployment does rise, which seems unlikely, it's only got room to rise slightly. Systematically, there are just a lot of challenges in the labor market that make it hard to have high unemployment. We'll talk on some of the data for that. And then again, inflation continues the downward trend overall. But if there's a downward trend overall, but we have seen that one outlier recent spike. Just need to watch and see what happens for these next couple of prints, see if it's a new trend or if we continue our downward movement overall. So looking at economic growth, looking at the components of GDP, this in and of itself has changed very little. Really not even just since last quarter, but for the last 3 quarters overall. The U.S. economy ended 2023 on a high note now that all of the data has shook out, with the fourth quarter making the 6th consecutive quarter of growth at or above 2%. While the economy may struggle to match last year's impressive performance, 2024 looks set to be another year of expansion. Again, all that data does look pretty good. Consumers have displayed impressive strength. We're supported by a tight labor market. Some signs of stress are emerging, not labor market related, but you'll hear data points on revolving credit as a share of disposable income. Not flashing warning signs, but the components of it that are auto loans, credit card loans, delinquencies on those have started to rise. They're above pre-pandemic levels. Student loan delinquencies, which haven't really been a thing for a couple of years, just because, payments haven't been required anyways. Say what you will about loan forgiveness, and we don't try and guess how that all is going to work out. But it's expected that now that repayment is required, depending on income, student loan delinquencies may be likely to follow as well. Again, that's just if we're looking for, 1 or 2 possible cracks in the market. Those are some of the negative data that we've seen. And overall, as a tight labor market, rising real wages are all offset, dwindling excess savings, leading to tighter credit conditions. Consumers should continue to spend at a more moderate pace this year. We never like to underestimate the American consumer's propensity to spend money. Americans are very, very good at that. It's why our economy has been as strong as it has. Given the chance, often, you can say what you will about a future retirement crisis, Americans will spend money even if they don't quite have it. So it seems that there should be no slowing in consumer spending through the rest of the year. Transitioning that over to business spending. Business spending has been challenged with tighter lending standards. Rates are higher. All of those financial institutions are wanting to be a little bit stricter with their underwriting processes and their lending standards, just to avoid any sort of default, especially if we were to move into something like a recessionary environment. But overall, business spending has been better than expected given those tighter lending standards. If we had to look at where businesses spend their money and what have been contributors to it, it seems that there's been an increase in spending on intellectual property. And overall, what that means is a greater emphasis on, developing and investing in artificial intelligence capabilities. Tailwinds from AI spending and support from federal government for AI spending should continue to at least partially offset the impact of higher interest rates. And, inventories are going to continue to grow overall at a steady pace. What just remains to be seen that, tighter lending standards haven't put a crack in anything yet. But if rates remain where they are and we don't see cuts and it continues to be an extended period of tighter lending standards, if corporate profits start to weaken, very much could still see constrained growth in capital expenditures. All of those things that have kept our economy going, there is still very much the potential to see some slowing in those areas. Housing market, it's tough to talk about housing market just because it feels like Texas is completely immune to any sort of housing market volatility. Yeah, maybe things are on the market a little bit longer than they had been previously. Maybe they're not quite selling at, super elevated peak levels that they were in 2021, early 2022. But for the rest of the United States, housing market has stabilized at somewhat depressed levels. And it seems unlikely that we're going to see just like a real estate boom in the near future, given mortgage rates. It is more expensive to buy a home because of those mortgages today. There's still very much is tight supply, which could suggest that a recovery in activity, start seeing more volume, recovery in activity is more likely than a decline in activity. It just remains to be seen on when we come to actual real estate values, how those offsetting, changes in supply and demand, if they're really going to drive prices much, much higher than they are right now. But for the most part, for everywhere that's not Texas, it seems like the housing market has stabilized, lower levels than it was a few years ago, but stabilized nonetheless. So overall, if we're talking U.S. economy, we remain on track for a soft landing, meaning that inflation got really high. The Federal Reserve responded. They started raising rates. They successfully got inflation under control, or under control enough, close enough to their target. And, the culmination of a soft landing is that they do all of that and avoid a recession at the same time. So we're still very much on track for a soft landing, but there are a few data points that could suggest that last year's momentum has the potential to fade. I'm not going to try and guess what it's going to be. We just got to be mindful of keeping an eye on that data. And then overall, there is a U.S. election on the horizon, which we will spend very little time talking about this update, and it's probably reserved for the next one, if not, beginning of the fourth quarter. Very much still higher policy rates, elevated geopolitical tensions. There are very much things out there that are not impacting the economy today that have the potential to, that we just need to very much be mindful of. CPI. So inflation, as you can see, particularly on the right-hand side, we had been flattening out quite nicely since September, October of last year. We've had very much an overall downward trend. That's pretty noticeable in the data here. But particularly in this services ex shelter, you'll see that what was a nice flat trend really surprised us with a 4.7% core services ex shelter CPI print as of the most recent week. That we just need to see if that was an outlier, or will we return to this, mid to low threes inflation level. Again, it's supposed to be a Q1 market update, so based off of all of the data before that print last week, overall CPI peaked at 9.1% in June of 2022. We did see a very nice steady drawdown in inflation, where it started to hover around 3.2% for headline inflation overall, starting at about October last year. And really, with that hover, the main concern at that point in time wasn't, is inflation going to reverse course? Is inflation going to start popping back up? It was just the fear that there'd be no further meaningful decline in prices, given how important prices are to the Fed in their interest rate decision-making process. That was generally the fear at the time was, are there still disinflationary forces that could keep inflation on its downward path this year? What is left when we look at prices that could keep things on the trend of downward trending prices? Overall, core goods, those prices trended lower in 2023. A lot of that is when you hear about, supply chain constraints post-pandemic after the Russia invasion, stuff like that. Lag effect for all of that kind of data, for all of that prices. So for 2023, a lot of those core goods, which are input prices for a lot of companies, we did see some continued trending lower in 2023. Some of the more volatile components, energy prices have risen in recent months. Um, Food prices, another volatile component, they've eased a little bit. Again, inflation is always prices going up. It's just the rate at which they go up. We like to see that declining. Those are some of the two more volatile components. Moving forward, looking at inflation estimates, uh, for the rest of the world, there's still slow global demand that limits likelihood of a surge in either of these categories for inflation, for food prices. But the one thing that is the potential and is usually the prime culprit for inflation being sticky, it was particularly shelter inflation. Um, you know, it it has improved a little bit, but we do have a systematic shortage of housing, particularly affordable housing, particularly multifamily housing in the United States, where the main concern for any sticky component tends to be shelter of, can those market rents move much lower, remains to be seen. So the what that leaves us with in terms of inflation is core services excluding housing, like we see on the right-hand side here, of which, given the updated data, this was as of today, so it does include our most recent inflation prints. These are the culprits today of not only have those declines stalled, but we have started to see a reversal in many of those components increasing. Recently, it's been medical, auto insurance, other transportation services have continued to expand, and saying, hey, what can we do about this part of inflation? If we want to talk about something being sticky, we want to talk about getting to our target inflation rate, a lot of that falls here. So, overall, the moderating wage growth should allow some of these prices to trend lower as wages increased, while a lot of it was to try and stay ahead of inflation. As those increases lagged beyond the rise of inflation, or as we started seeing our downward trend, there were a lot of American consumers that just felt like they had more money to spend. A lot of that money gets spent on services like these. Now that wage growth is moderating, we should start to see some of these services prices trending lower through the end of the year. But, that outlier of last month, most recent inflation print is concerning in terms of, have we interrupted our disinflationary trend? Are we moving towards a new normal, a new trend? That some of our prices for various services indicate that we might be, that we just want to see how it continues to play out. The main impact that it'll have overall on any of us is not only, how much do all the things you do and the things you buy, how much do they cost, but will be, what does the Fed take from this data? How do they change their path for interest rates using it? Particularly if we enter into a new trend. Overall, they were thinking we'd be at their 2% target by the end of the year. If we are far and away from that, it may lead to a drastic change in interest rate policy. Last thing on economics is just overall labor supply. The labor market's normalized from its post-pandemic boom. After economy reopened, businesses reopened, we saw a huge rise in the number of new jobs. But U.S. economy still added 250,000 jobs per month in 2023, and has sustained that pace into early 2024. This occurred even though unemployment rate itself has been, at 4% or lower since December 2022. The longest streak of unemployment being that low since the late 60s. Despite fears of an economic slowdown, strong growth in the U.S. labor supply has allowed employers to steadily hire workers and narrow the gap between, supply and demand. There were times when there were, for every person seeking employment, there were 2 open jobs. that has started to compress a little bit, narrow that gap between supply and demand. After falling sharply during the pandemic, labor supply in the U.S. staged an impressive recovery over the last 2 years, and it's largely been due to increased immigration. So in fiscal year 2023, Immigration Services approved over 2 million applications for employment authorization, which is a 70% increase from 2022. 2022 had been the previous record of 1.2 million approved applications. And so to not, so just so that there's no politics that have to be involved here, these are all people legally applying for, work in the United States. This is all, on the books, it's above board. These are the type of immigration, this is the type of immigration that our economy needs to fill roles that are largely going unfilled. And so what's been interesting for employers is with this surge in migrant workers, employers were able to fill open jobs without applying upward pressure to wages. So it's what's helped us to explain why strong job creation hasn't sparked higher inflation. It's why wage growth was rising rapidly coming out of the pandemic, but has since stalled. It's a lot of people that are new workers, and on both sides of the equation, they're contributing to new jobs while also being new entrants into the workforce, filling a lot of those jobs. The other factor is that the strong recovery in the labor force participation rate has boosted labor supply overall. What we're seeing still is that, aging baby boomers left the workforce during the pandemic. They never really returned. So their participation is still lower than it was before. They're all retiring. That's reasonable. We all knew that was going to happen with changing demographics. But of those aged 18 to 64, and again, this is excluding any sort of immigration, but for those, for U.S. citizens aged 18 to 64, we have fully recovered our labor participation rate to pre-pandemic levels. So anyone who left the workforce, left the labor force temporarily during COVID is back. Labor force participation is just as high as it was prior to the pandemic. Moving forward, how is all of this going to impact our economy going forward? There's still elevated job openings. Moderate economic growth point to steady job gains ahead, that there's still more people that can be hired. While this would seem to imply that, hey, our unemployment rate should likely decline if there's only more people getting hired, the continued influx of migrants should provide a fresh source of workers where unemployment rate is going to stay low without necessarily falling with all of these new jobs. But by all considerations, should stay in a pretty narrow range, 3.5%, 4%. As we mentioned, with baby boomers largely exiting the workforce thanks to retirement, there's systematically less workers than there used to be. And so lastly, we'll tie it all together with our implications for investors. What do we do with all of that data? I will start with a quick repeat of our implications for investors that we talked about last quarter. As I said, there's a lot of stuff that doesn't really change a whole lot quarter to quarter. We won't talk through slides or anything for these, but things I want y'all to be mindful from asset allocation standpoint, in that inflation. So all of this started with inflation in terms of why the Fed started raising rates, why they started entering into quantitative tightening. It all started with inflation. It'll end with inflation as well. That's why the one economic indicator that I do track more than likely any other is inflation. It has such an impact in all other asset classes because of how closely the Federal Reserve monitors it. From a fixed income standpoint, review allocations to various terms. So how long are your dated are your bonds? When are they maturing? Your credit qualities, the sectors of bonds that you have. We talked about the asymmetry that exists in the fixed income markets, where whether rates were to rise or rates were to fall, wildly different outcomes in terms of being skewed towards much higher positives, much higher expected returns and much lower possible losses relative to where we were at the end of 2021. It's still likely that rates will move lower at the end of the year into 2025, but they still may settle at a higher level compared to previous policy easing cycles. I would emphasize what is different this time on fixed income than last time. Just don't worry about getting the timing perfect. With inflation surprising us coming in a little sticky, a little bit hot, it overall is, we don't know what rates are going to do by the end of the year. What seemed very easy to predict of, hey, rates are only going down. Now we've got a little bit of a surprise, and don't worry about getting the timing perfect. Just allocate for a reason. The last thing for equities, high quality companies, strong balance sheets, ample cash flows, sustainable earnings. All of these are great indicators for companies, whether the economy is good, whether the economy is bad, whether AI changes the world, whether it doesn't. Those are things that we like to focus on in our equity allocations. And then we can't, overlook the fact that the top 10 companies in the S&P 500, make up a third of the index, but only contribute about a quarter of the earnings. It suggests there's some mispricing in the stock market. Don't forget that there are a lot of companies, publicly traded companies in the United States, that aren't the top 10 largest companies. Make sure you're being mindful of that with your asset allocation. And so now for our new implications for investors is overall, we just want to focus with all of these mixed indicators, market expectations, and how's reality going to differ from these expectations. We just want to make sure that investors are focusing on what they can control. So our first implication for investors is to just avoid common mistakes. What are some of our common mistakes? Trying to time the market. Investors may be tempted to cash out of the stock market to buy back in when they're predicting a downturn, when they're predicting stocks to run away. But overall, accurately forecasting the market's direction in any of those short time periods and using that as an indicator of when to buy, when to sell, it's absolutely just a guessing game. If you miss only a brief period of strong market performance, it can drastically affect your overall lifetime wealth. So for example, what this chart shows is that if you had a hypothetical $1,000 that you invested into the Russell 3000 in 1999, Russell 3000 is a good indicator for the entire US stock market. Over that 25-year period, ending at December 31st, 2023, $1,000 investment becomes $64.49 if you stayed invested the entire time. But if you tried to time the market, if you pulled your cash out, if you sold, if you tried to go to the sidelines, and if you did that at possibly the wrong time, if you missed the best week, which was the week ending November 28th, 2008, instead of $64.49 when all was said and done, you'd have $53.82 just by, in a 25-year period, missing 1 week. As you can see, if you miss the best month, if you miss the best 3 months, it continues to stair step downwards to the point of, if you missed 6 months, the 6 best months of a 25-year period, which was the 6 months ending September 4th, 2009, instead of $64.49, you'd have $4,185. Don't try and time the market. It is a common mistake that investors make. Even missing short periods of good performance can drastically change your long-term returns. So just stay invested. Don't try and predict when stocks will rise and fall. Buy a globally diversified portfolio, hold on to it, and stay invested. You'll be better positioned to capture returns whenever and wherever they occur. As our second mistake that we want to avoid is focusing on the headlines. So investors, recently, more so than ever, have become enamored with popular stocks that, based on recent performance, recent media attention, are over-concentrated in their portfolios. They're companies that are just doing really well lately. One example of this is the rise of large U.S. technology, the Magnificent Seven. That's Alphabet, Amazon, Apple, Meta, your Facebook, Microsoft, NVIDIA, and Tesla. But what the chart here shows us is that many fast-growing stocks have stopped outperforming after becoming one of the 10 largest stocks in the United States. So on average, companies that outperformed the market on the way up fail to outperform in the years after making the top 10 list. After they join the top 10 list, we see for 10 years after, it's not uncommon to have negative returns compared to 10 years before. They were earning 11.8%, almost 12. They're 20%, 27% 3 years before, well above average for markets. But once they find themselves in the start of the first calendar year that they're in the top 10 largest stocks, the story does change quite a bit. So the lesson here, rather than loading up on stocks that have dominated the market recently, that have gotten them to those top 10 largest stocks overall, you can own many stocks, be diversified, own a mutual fund, ETF, total market, and diversifying across industries, across global markets, can help reduce overall risk and position investors to potentially capture returns of the future top performing companies instead of just the most recent top performing companies. Our third, which goes kind of hand in hand, our third mistake that we want to be mindful of investors avoiding is just chasing past performance. When you might be inclined to select investments saying, hey, this has performed the best for the last 10 years based off past returns. And of course, it's going to continue to do better in the future. But expecting top ranked funds to continue to deliver the best performance, it's unlikely that they're able to maintain that outperformance. Research shows that most funds that are ranked in the top 25% based on 5-year returns did not remain in the top 25% for the next 5 years. In fact, only 1 in 5 equity funds stayed in the top performing group, and only about a third of fixed income funds did. So when we're looking at past performance, it offers limited insight into future returns. There are more factors that matter. Is performance a factor? Of course, it's a factor, but there are more factors than just performance for choosing an investment allocation. So that summarize, our first implication for investor is to avoid common mistakes. Don't try and time the market. Don't focus on the headlines. Don't chase past performance. Just focus on what you can control. And if you do that, you'll avoid those common mistakes. So the other thing that is an implication for investors is, as I mentioned, at the end of March, we hit new all-time highs in U.S. equity markets. And it's something that we hear a lot of, goes hand in hand with market timing, is, now that stocks are at all-time highs, it can't possibly be a good time to invest if I haven't started investing yet. Oh, it can't possibly be a good time to hold if I was an investor up until this point in time that participated in markets running up to the new all-time highs. But what we can see is that for average cumulative S&P 500 total returns, looking forward from previous all-time highs, particularly ones that set a market floor, meaning that it hit a new all-time high and then never returned back below that. Overall, you earned more looking forward, investing at a new all-time high, even looking at 3 years ahead, earning 48.1% on average if you invested at any of those new all-time highs, versus any other day in that same time frame, earning 40.2% cumulatively over a 3-year period. And so all of this to say that all-time highs are not a bad thing. You've participated in growth to this point in time, and even if you were on the sideline, you were in cash, or you just didn't have money to invest, you haven't missed out. Being at a new all-time high should not keep you from investing in equity markets. In fact, a lot of the best periods of performance historically have been following new all-time highs, especially when those all-time highs set a new market floor in which prices never fall back below that. We don't know if that's where we're going to be today with this new recent high, and we're a little bit down from where we're there anyways. So I think we've already, decided that we have not set a new floor based off of it. But don't let a new all-time high keep you from investing. Very much history is on your side to say that lots of gains can still be had. So all-time highs are no reason to change your investment strategy. Maintain a systematic approach. Don't let something like the level of an index today drive whether or not you should invest in it. Ignore all-time highs. It's great. It means you make some money on the way up, but don't use it as a reason to change your strategy. And then the last thing, which is a little bit of a repeat of what we talked about last time, is just the opportunity cost of CDs. And then also interchangeable with the opportunity cost of money market funds, high yield savings accounts. So right now, we talked about an inverted yield curve. You can get 5+% in your high yield savings, in your money markets, in your CDs, and a lot of longer dated bonds are paying you less than that. And so we hear a lot, why would I take a 10-year bond at 4% when I can have a money market fund with seemingly less risk that's paying 5% today? And what we need to be mindful of is that as rates fall, those very short-term rates, being CDs, being money markets, being high yield savings account, just like they were the first things to increase their yields when rates were rising, they will be the first things to decrease their yield as rates fall. What we're looking at here is forward returns, 12-month returns during previous rate hiking cycles, and how different asset classes returned in the 12 months following. Gray bars with gray dots being, 6-month CD rates. On average, just summarizing all of these periods together, 6-month CDs provided an annualized return of 7% in the following 12 months from a peak, but the Bloomberg US Ag, which is the benchmark for the overall US bond market, returned 15% in that same time frame on average. The S&P 500 returned 22% on average in that same time frame. And then a 60-40 portfolio, combination of the two of them pretty much, returned 19% at the end of a rate hiking cycle following the peak. And so all we want to be mindful of still is that have a plan for your cash, when to put it back to work. I'd say given our recent inflation print, it doesn't need to be a rush decision, but just be intentional with that decision. Know why you have as much cash as you do. Put everything else to work on a longer time frame. As those rates begin to fall, any excess cash that you have hanging out in money market is going to earn you less as time goes on. And by the time you go to pivot to longer term bonds, 5-year bonds, 10-year bonds, the rates on all of those will have fallen as well, where it makes it harder to make that decision after the fact. You have to be diligent. You have to choose to allocate further out on the yield curve prior to rates starting to fall. Don't have to get that decision perfect, but just make sure that you're investing on both ends of the spectrum. Start considering moving systematically out of cash, out of money market through the end of the year, and just do it all with purpose. And thank you all for attending today. Here's how you can reach us with any more information. As always, your situation is completely unique. None of this information was unique. It was all very general. Anything that we can do to help, anything that might have sparked an interest on this presentation as it pertains to your personal situation, please reach out to us. Please give us a call. We are always here to help you or anyone that you know of that may need help with good financial planning advice, good wealth management advice. Thank you all for attending, and hope everyone has a nice day.